Ever wondered how investing works or what it really means to buy stocks, bonds, or crypto? Well, you're in for a treat. Today, we're diving into the world of investing, a critical tool for wealth creation. We'll be exploring the basics of three key investment types: stocks, bonds, and cryptocurrencies. Each of these has unique features, risks, and rewards. We're here to make this journey easier and more rewarding for you. So buckle up as we demystify the world of investing. First off, uncovering the allure of stocks. Let's dive into the world of stocks. At its core, a stock represents a slice, a share if you will, of a company's ownership. When you buy a stock, you are essentially buying a piece of the company, and as the company grows and earns profit, so does the value of your stock. In the grand scheme of things, stocks are a crucial part of our economy. They allow companies to raise capital for growth and innovation. This in turn fuels economic progress and creates jobs. Now, how do investors make money from stocks? There are two main ways. First is through capital appreciation. This is when the price of the stock increases over time. For example, if you bought a stock for $50 and it grows to $100, you've just earned a $50 profit. The second way is through dividends, which are a portion of the company's profits distributed to shareholders. Not all companies offer dividends, but those that do provide an additional stream of income for investors. But just like a thrilling roller coaster ride, the stock market has its ups and downs. Yes, investing in stocks can lead to high returns, but it can also lead to significant losses. The value of stocks can fluctuate widely in short periods due to various factors such as economic indicators, political instability, or changes in the company's performance. Therefore, it's essential to do your research and understand the company and its industry before investing. Moreover, diversification, or spreading your investments across a variety of stocks, can help mitigate the risks. Think of it as not putting all your eggs in one basket. This way, even if one stock performs poorly, others in your portfolio may do well, balancing out potential losses. So, while stocks can offer substantial rewards, they are not without their risks. But with careful planning, research, and a dash of patience, investing in stocks can be a rewarding journey towards achieving your financial goals. Moving on to bonds, the less risky sibling of stocks. Think of a bond as a loan you give to an organization like a government or corporation. In return, they promise to pay you back the amount you loaned, called the principal, on a specific date, known as the maturity date. Throughout the life of the bond, you'll also earn interest, typically paid out periodically. This essentially makes you, the bondholder, a creditor of the organization. Bonds are known to be less risky than stocks because the organization is legally obligated to pay you back. If a company goes bankrupt, bondholders are usually paid before stockholders. However, this doesn't mean bonds are risk-free. There's always the chance the organization could default on its payments. And while bonds are generally more stable, they can still fluctuate in price due to changes in interest rates or the creditworthiness of the issuer. The potential rewards from bonds are typically lower than those from stocks. This is because the interest rate on a bond is fixed at the time of purchase, so your earnings are predictable and generally steady. You won't see the dramatic jumps in value that can happen with stocks, but you also won't experience the sharp declines. Bonds can be an excellent choice for those looking for more stability in their investment portfolio. They can provide a steady stream of income and act as a cushion against the volatility of the stock market. Depending on the issuer, some bonds are even tax-exempt, meaning you won't have to pay taxes on the interest you earn. However, it's essential to remember that lower risk usually equates to lower returns. So while bonds can help protect against losses, they may not offer the high growth potential that riskier investments do. It's all about finding the right balance for your personal risk tolerance and financial goals. Thus, bonds can provide a safer harbor, but with potentially less wind in your investment sails. Finally, we step into the future with cryptocurrency. This isn't just digital money, it's a whole new way of thinking about finance. Cryptocurrency is a digital or virtual form of currency that uses cryptography for security. It's decentralized, meaning it operates on a technology called blockchain, which is a distributed ledger enforced by a network of computers called nodes. Now let's talk about the elephant in the room, Bitcoin. It's the first and the most well-known cryptocurrency. However, since Bitcoin's debut in 2009, thousands of alternative cryptocurrencies have been introduced, each with unique ecosystems and infrastructure. Investing in cryptocurrency can be like riding a roller coaster. It's highly volatile, which means the value of a cryptocurrency can change rapidly in a very short time, making it possible for investors to experience significant gains or losses. Factors such as regulatory news or events, technological updates, and changes in market sentiment can drastically affect the price of cryptocurrency. This volatility can present opportunities for massive gains. If you'd invested $100 in Bitcoin back in 2010 today, you'd have a fortune worth millions. But remember, with great potential returns come great risks. Cryptocurrencies are not only extremely volatile, but also highly speculative, and investing in them can lead to complete loss of capital. It's also worth noting that while cryptocurrencies may seem like the new gold, they are not as stable as traditional investments like stocks or bonds. They are not backed by a government or a commodity, and the value is purely based on what the market is willing to pay for them. So, before jumping into cryptocurrency investment, it's crucial to do your research. Understand what you're buying and be prepared for volatility. There are various resources available online to help you understand the market dynamics and the technology behind it. In conclusion, cryptocurrency investment can seem like a wild ride. It's an exciting new frontier in the financial world, offering significant potential rewards, but it's not without its risks. So, crypto can lead to a gold rush or a bust. It's the Wild West of investing. So, we've journeyed through stocks, bonds, and cryptocurrency. We've seen that stocks offer ownership in a company, bonds are essentially loans that you give to entities promising to pay back with interest, and cryptocurrencies are digital assets secured by cryptography. Each carries its own risk and reward, and it's crucial to remember that investing is not a get-rich-quick scheme. It requires patience, research, and a clear understanding of your financial goals. Remember, the key to investing is not in chasing quick returns, but in understanding the risks and making informed decisions. Happy investing!